Kathleen Smith. Kathy Smith is the manager of the Renaissance IPO ETF. The ticker is IPO, of all things, Kelly. So let's talk about, Kathy, what's going on here? Why are the IPOs lagging? It seems to me that's not a good sign of sentiment for the overall market.
Well, the reason that we've had so much record issuance in 2021 is that the returns were so good in 2020. So this index, the IPO index that we run, was up over 100%. So it's kind of hard to repeat that performance. The fact that the returns are holding up fairly well, and they've kind of gone back and forth. As a matter of fact, we had a very good third quarter till we ran into this week with a lot of turbulence over rising rates. It actually has not been too bad. And it's important because if the returns are not strong, the IPOs, they're going to be discounted, which we saw happen in this third quarter. And investors are going to be a lot more careful about what they buy. They need to make money in the aftermarket trading.
So Kathy, I mean, if you take a look at the way things are shaping up right now, Warby Parker is not a technical IPO, but it's coming public in a big way. It's up 35% right now, the last I checked, even though it's a reference price and not an actual IPO price. What exactly do you feel as though is the sentiment right now? Are these IPO-type pops still here to stay? Has the SPAC craze kind of died down a little bit, taking some of the luster away from the public offerings?
I can comment on all of those. I don't think they've taken away at all because we're at record levels for IPOs, and the returns are still pretty good. Half the companies that have gone public are trading above or near their IPO price on average. So that's pretty good. There's a good reason to come in. We are seeing price discernment in the market. A company this week pulled its IPO. Investors weren't that interested in it, so not everyone gets the enthusiasm of Warby. But when it comes to SPACs, I think we hit peak SPAC at the beginning of this year, and we're seeing a much more modest amount of issuance, even though it seems so large when you look at it in total. And that's because the returns haven't been good. You know, on average, after they de-SPAC, about a third of the companies are trading above their IPO price, not too good, and the average return is negative. The direct listings have done all right, and I want to comment on that relative to Warby, and we've had 12 of them, starting with Spotify back in 2018. But the direct listings have one problem. You know, an IPO usually has a lockup, and the reason for the lockup, it's not good for the investors there, but for new investors, they want to see the company show performance in its results for a while before insiders can sell. So there's a large overhang of stock with a direct listing. And when it comes to Warby, they certainly deserve the attention of investors. That's a strong brand. They're a leader in direct-to-consumer. They've done a great job. However, they're about 80% of the shares that are outstanding now for Warby are able to be sold. And there's some things that I would point out that maybe Warby has done a good job of selling today's investors the rose-colored glasses, because this is a company that still is going to have a lot of overhang with the shares, and also has the, it's being priced at a tremendous premium to anybody else in its peer group. So I think Warby's going to have to do a lot to prove this current valuation that it has.